Okay. All right, Mark, hang on just a couple
I'm
minutes.
ready.
Hey, good afternoon, everyone. Happy to have you all here. This is our first webinar of the year. Happy New Year to everyone. And forgive me, I don't have any music keyed up today, but we'll have that back tomorrow. But even better, I have a wonderful, wonderful guest lined up a little bit later on today, and it's legendary technician and analyst Marc Chaikin, who is going to share some slides with you all in a little while. And it's an absolutely just a tremendous treat to have him on here. Marc is absolutely, he's one of the most skilled technicians I've ever seen and I've ever met. And I would suspect that at least 95 to 98% of you in the room here have probably used Marc's tools, the Chaikin oscillator, the Chaikin money flow, or anything else that he's used. And I know quite a few of you in the room are subscribers to Chaikin Analytics, and I use it every single day. It's a tremendous tool. It's a time saver. It does everything. But I don't want to let the cat out of the bag here. Marc's going to talk about it a little bit later on because I think this is going to be an opportunity for you guys to all jump on board and with Marc's product, and really basically he lets you see and trade what he's seeing, and you're almost in a virtual office with him by using the Chaikin Analytics. So that'll be an opportunity for you guys to do that. But first things first. Again, I wanted to welcome everyone to the webinar with me. This is our first one of 2016, and we're going to have a short talk about the markets here. I'm going to talk a little bit about volatility, and then Marc, I'm going to turn it over to Marc. He's got a great presentation talking about profiting from the volatility, which is kind of appropriate now, apropos as we speak, because volatility has certainly started to kick up its heels here with a lot of uncertainty that is happening in the world these days. So I think to a man, quite a few of us are confused and wondering what to do next. And I think we're all very lucky and fortunate today to have Marc to kind of guide us in a way that will help us navigate through this market. Otherwise, we're going to end up, at the side of the road, trying to hitchhike instead of driving away in our car. So let's take a look at the chart just for a few minutes. And again, Marc will bring up his stuff in a little while. But as we can see here, what's happened for 5 of the last 6 days has been some really intense selling. And I don't have to tell you that, but we've had 5 days of really intense selling. But if you look up here, we notice something on this particular day. This was the 29th and the 30th of December, okay? A couple of days before New Year's, last week. We call this green and the red bar the king and queen, all right? And if the king and queen together, the king meaning the up day and the queen being the down day, no disrespect to the ladies there, but that's just kind of the terminology that's used here. If the king and queen are here and we get follow through to the downside with the queen, it keeps going. It works the opposite way when we get a queen and king. We saw the same thing occur right over here back in early December, and we also saw the same thing happen in the middle of December. So again, that's just the terminology that's used here. Did we expect to see so much downside here? No. Did we expect to see so much downside here? Well, probably not. But it's one of those things that is a clue to what the trend is probably going to be going forward. So what's happened here recently? So today we had a really bad day. I mean, as I was talking with Marc earlier before we got started, this seems to be the year of the black swan, right? And this week alone, we've had 4 somewhat called black swan events happen. Black swan events meaning they're things that were unexpected and the market takes it as a shock, like an earthquake, right? Now the markets can genuinely handle once a year, once every 6 months maybe even 2. But 4 in 1 week, we had the Saudi government executing an Iranian cleric, and that caused a lot of turmoil and a lot of pullback in crude. We've seen crude break $32 or $33 last night. It did close above that level, but still it's weak, and we could probably expect crude to be coming down even further. It's just been weak for the better part of 15 months, ever since we broke 80, 82 back in Thanksgiving of 2014. We had some more events with China. Two of them this week. We had that selling that happened on Monday, and then they halted trading. They did it again last night, and then we had the H-bomb testing by North Korea. And again, there's no model out there that can price these things in. All right, Marc Chaikin is good, but with all due respect to Marc, he's not that good that he can predict these things happening. However, there are clues in the charts, there are clues in the technicals that could help us gauge that something could happen, and if it is going to happen, what we can do is we could put on protection or play defensively, right? Or just go on the sidelines and sit in cash. A lot of the things that Marc will talk about with the Chaikin analytics, you'll be able to see that if they're, for the one great tool is the power bar gauge, and the power bar will tell us how many stocks are bullish and how many stocks are bearish, and that's kind of a no-brainer. If you've got a majority that are bearish than are bullish, well, again, you're going to be heading to the sidelines or else taking up a bearish stance. Now, one thing about this chart that I want to show you is that we broke some support here, and we closed at below the lower Bollinger Band. We're probably close to the third standard deviation now. If we get to the fourth standard deviation, that's probably going to be an area where we're going to turn right back up again. The quality of that turn is going to be important to see. We did have a big turn here. Obviously, in August, we bounced really sharply. Then we double bottomed over here. And some of you may remember that Marc was on a webinar with me back around this time, and we sort of had a little, I don't know, a mini competition. We were talking about which direction the market was going to go into, and my guess was that we were going to keep going down, and Marc said we were going to get a W, and he won. So you can see clearly the left side, the edge here, and then we hit that W, and then we did make a big fat W over here. Hey, I'm not going to tell you what he's thinking, but I'm sure we'll be wanting to listen to him very closely, very carefully, because he did make this call correctly, and if he's going to make this call again, we want to pay close attention and follow along with what he thinks. So it appears that we've got some more downside to go here. I would say that possibly 1900 on the cash index over here, and the reason for that is because that was some pretty good support back over here. We caught it, we went through it and caught right back up, and we had what's called a morning star over here, which is a red, a doji, and then a green right after that. We followed through. So we'll have to see if that gets tested one more time. We've had some really violent moves here the past 3 of the last 4 days. We had in August, okay? And we'll get exhausted here. I mean, the oscillators are going to show some very deep oversold readings today. They're not up yet, probably going to be up in about 15-20 minutes, so I'm not going to show you that yet. But in any event, we could come down a little bit further. We did buy some puts today, and so we have some protection. We are long some calls, and those are hurting us right now. But we do have some longer stuff in February and in March, so we'll wait and see. The last thing I want to talk about here is volatility, and the VIX term structure here. We always talk about VIX, and Marc's presentation is going to be on volatility, so this is going to be a really nice segue into that. So we talk about the VIX and the VIX futures, right? And the VIX cash rose sharply today and closed at just under 25, 24.99. That'll be coming up in just a moment. And we have an inverted curve once again, much like we had back in August. So what does that mean? So that means that people are looking for big moves in short-term volatility. And how do I know that? Look at the VXST right over here. This is the 9-day volatility, which clocked in at 26.19. And when this is above the VIX, that means the market is pricing in lots of volatility in the short run. And that would be like the next couple of weeks. But also, look at the January VIX was up almost 16% today and inverted the curve. And yesterday we saw that the January VIX was well above the VIX. Not today. So this VIX up here, if it stays up here and keep moving up, which won't last for very long, but it is in spiking mode over here, but it won't last too long here. Once this VIX moves up, it's going to pull this curve up as well too. So we're going to see these other futures start moving as well too. So all I'm saying is this: the market is saying danger, Will Robinson, right now. Be careful. And markets are pricing in options for big, huge, substantial moves because it's also pricing in the markets for big, huge, substantial moves. So that's why we buy some protection. We bought some 195 puts today and some stuff for next week. We do have some calls on there, so we actually do have strangles on. Just in case it does turn around the other way. But I suspect that we have a little bit more downside here. These things don't resolve when we finish at the lows of the day. Although that did happen here in August, we did have 4 to 5 days downward over here. And we had one over here, and then of course, we had a doji the following day. So if we get a doji the next day, and then we pop up on Monday, well, that may be a start of moving right back up. But clearly, I wouldn't call this a bottom today. I don't think Mark would call it a bottom. I don't think any of you guys would call it a bottom today, right? I mean, who in their right mind would want to stick their neck out here and say that, okay, 1943, that's it? Especially when we got China opening up and they've got all sorts of issues like they did last night, and I guess they released the whatever the halting of their securities and the 5% to 7%, whatever it was that caused markets to tremble last night. And then we've also got the jobs report coming up tomorrow, and there's I don't know what in the jobs report is going to be positive for the markets, other than the fact that if all the selling has exhausted itself and we're done with it, then we're going we may turn right back around and go up. But again, I'm not smart enough to say that this is the bottom, but we'll have to see and play it accordingly. So that's that. I'm going to. Oh, by the way, I forgot to mention to you before I hand it over to Mark here that if you guys have any questions on anything for me or for Mark, please go ahead and open up your chat box window and type in your question, or if you have any comments or whatever, that's fine. You guys can hear me okay, right? Because somebody was saying that there's no sound. Mark, you're hearing me okay, right?
I can.
Okay, great. Okay. All right, so good. All right. And if you have any questions for Mark or for myself, please type it in over there. We are recording the session. Mark's going to be with us for a while, and he's going to go through his slides right now. He's picking them up as we speak, and I'm really excited to have him in there. So real quickly, Marc Chaikin, a very good friend of mine. We met last year, and it just hit it off right away. And Mark is just a fantastic person, one of the nicest people I've met. There are some nice people in this business, but there are some people who act nice and they aren't very nice. Mark is one of the nicest people you will meet, and he is just so gung-ho and has so much energy and excitement, and he knows what he's doing. He's been in the business for 50 years, and I'm just excited and delighted whenever we get to a chance to work together or meet up to talk with him. He's just so good and so dynamic. He's got a great product, and he loves to share it with everybody. It's just so good, and I think this is a great opportunity, a great treat for all of you guys. I'm excited to have him in here as my first guest for 2016 webinar. Mark, good to have you today.
Bob, it's great to be on, and thank you so much for that very incisive market analysis. You're very humble because you don't talk about the big winners like the 10x trade in Google and some of the other big trades that you've had in individual stocks. But one thing I want to point out, which we discussed earlier, is people are nervous, and rightly so. But as the Chinese say, chaos equals opportunity, and Warren Buffett has famously said, be bold when other people are fearful and be fearful when other people are bold. So there's opportunity in the markets, and what today's presentation is going to be all about is volatility and how it can become your friend and help you make money, and it shouldn't be something that impedes you from participating in the market. But just to speak to a comment that you made, that you can't really know where things are going, sometimes you can have a fairly good educated guess. So we write a weekly market letter that comes out on Sunday called Chaikin Market Insights. And in this Sunday's letter, the headline was "A Cautious Posture is Warranted in 16, but no bear market in view." Now, we had a plan coming into the week, and remember that because in volatile markets, the real key to surviving and making money is to have a disciplined plan, to believe in a methodology and follow it. So based on seasonal patterns, 2 days down at the end of the year suggested a 2 to 3 day rally. I'm absolutely convinced that would have happened if China hadn't blown up their currency and halted the markets. But you've got to readjust. So as soon as we saw that 2 to 3 day rally scenario fade, the operative posture is cautious. Now, I said no bear market, and we're going to start this webinar because I know so many of you are confused and concerned. In fact, I'd like to take a little poll here. 3 choices. You're confident that you know what to do, you're confused, and you're totally at a loss and likely to sit on the sidelines. So C for confident, B for befuddled, or L for lost. And let's see, let's take the temperature of the audience because it'll help me sort of guide the tenor of this. And Joe, you're always my go-to guy for the responses, or Bob, if you're watching.
Yeah, I've seen lots of Bs, Mark.
Befuddled. Well,
Lots of Bs. Some Ls, but lots of Bs and a few Cs.
all right.
But most,
So
I'd say 80% of them are probably Bs.
all right. Let me start out with the macro overview. These things work most of the time because they're based on history. I said no bear market in view, and here's the reason. Bear markets are associated with recessions in the U.S. economy. Now, there is an outside chance that if China just continues to self-destruct, blow up their currency, report negative economic numbers, that it spills over into the U.S. In 1997, it was called the Asian contagion, when all the Asian currencies were devalued. I think the likelihood of that is minimal. The U.S. economy has been the go-to economy for the last 5 years. Steady Eddie, slow 2 to 3% a year growth in GDP, a little bit of an expansion in price earnings ratios. There are no signs of a recession in the U.S. One of the key indicators over the last 60 years that has always been associated with a recession is what's known as an inverted yield curve. Very simple. An inverted yield curve exists when long-term interest rates are below short-term interest rates. Now, short-term interest rates are at 25 to 50 basis points right now. Long-term rates are at about 220 on the 10-year Treasury. Even if the Fed raises 2 or 3 times in 2016, it's almost a guarantee that long rates will not drop below that level. If it is, it'll be one of the great bond shorting opportunities of all time. So if there isn't going to be an inverted yield curve, and the likelihood of a recession is small, the likelihood of a bear market is small. The only thing that counters that is if you have a bubble in stock prices, like you did in 2000 in the internet stocks, and you did in 2008 in the financial sector, and all these leveraged mortgage instruments. You have to really scratch hard to find a bubble here in this market. The energy bubble, if there was one, has already burst, and the private equity bubble with what they call the unicorn private valuations for stocks like Uber and Airbnb is starting to unwind itself. So my view is no bear market. We define a bear market as down 20% in the major averages, in this case the S&P 500. The Dow isn't really your friend anymore because they keep monkeying with the Dow. So if that's the overview, let's take a look at 2016 from the point of view of the Chaikin indicators. And we're going to go to the slideshow. Before we do that,
Hey, Mark, I wanted to just make a quick comment because
whenever you can.
Because you were talking about a recession. I fully 100% agree with you, but I'm putting together a blog. I did some research because I wanted to find out if there is a similar economy to the United States right now with similar interest rate policy and how that looked going into a recession. There's only one country like that, and it's Japan. and they've had zero interest rates for as far as for a generation, over 25 years. And so they went. This is interesting because they went into a recession in 2000 after the dot-com bubble. A lot of countries went into recession with them, and then they had, for the next 7 years, they had 2% GDP with zero interest rates. Sound familiar?
Sure does.
Yeah. So, and then they had a recession in 2008, 2009, which was a result of the financial crisis. A lot of countries went into recession after that. But the recession was very shallow. I think they only lost like 0.8%. And while their economy wasn't as big as ours at that time. I mean, they were the biggest economy if you go back to the early 90s for a short period of time. They had a really shallow recession. So I kind of agree with you that we're probably not going into recession, but it's that yield curve thing that really is puzzling, because unless the Fed raises rates, like you said, to a much higher level than we are right now, that yield curve is not going to point at all to any kind of recession. It's got to be something else. So I think that if anything, if the worst scenario would probably be we contract like a small amount, nothing really to write home about. But if you drop from 2%, say, to 1% or even 0.5%, that's going to feel like a recession, isn't it?
It will, but there is one big difference between Japan in the late 90s and early 2000s. Japan was basically a state-sponsored economy, not as bad as China.
True.
The Japanese banks really were owned and controlled by the government, and so I had a mentor, Stan Burge from Tucker Anthony, who was really one of the most highly regarded market strategists of the 60s, 70s, and 80s. And Stan mentored me, and he had a great expression because he was very numbers and probability driven, which is what we are here at Chaikin. And he said, maybe it'll be different this time, but it rarely is. So I'm going to go with the patterns and the probabilities, but we always have to respect the technicals. There's no, Marty Zweig said it, and I've said it. Mr. Market is bigger than any of us. So what happened today, we broke some key support levels, and you've got to respect that. But a deep bear market here, I think, is highly unlikely, and all it's going to take is some sort of firming up from the Chinese government, who can't be happy about what's going on, and this thing will right itself. The good news is we know why the market's going down. The worst kind of markets that do cause people to be befuddled are markets where you don't know why it's going down, where you can only guess. So I think the fact that we know what it is and all the information is on the table, it's not a surprise that China has a weak economy. Suggests to me that we'll have corrections, and in that market letter I said we'd get corrections of 5 to 15%. Expect them. Be prepared for them. Take advantage of them. So let's dive in, and Bob, you feel free to dive in whenever you see a chart that resonates with you, because that's what makes these webinars that we do together so valuable for the people attending.
Thanks, Mark. Have fun.
Yeah. So I'll start out by asking you the key question. Have you ever wondered how to turn volatility in your favor and actually make money in volatile markets? And if you have, today's webinar is going to give you some insights into what types of tools and methodologies you need to do that. And the big question is, why Marc Chaikin? As Bob said, I've had 50 years on Wall Street. I've lived through 10 bear markets, 45 years using technical analysis to supplant fundamental research. I've been mentored by some of the smartest and most successful institutional investors, and what I learned from them is embedded into the Chaikin Power Gauge rating, which is basically the fundamental culmination of my life's work. My dream was always to create a quantitative model that could evaluate the fundamental picture of a company and tell you with a high degree of reliability whether that stock was likely to outperform or underperform the market. And what's interesting is that there are three key firms that sort of stand out in my career. I started with a firm called Shearson Hamel in 1966, and they were arguably the best research firm on Wall Street. 42 analysts, many of them went on to start hedge funds. Cumberland Associates is still going strong today with new leadership. Uh, and I got my broker's license in October of 1966, the day the bear market of 66 ended. It was a 9-month bear market. So for the first 2.5 years of my career, and I was 22 years old, every day looked like an uptick. It's sort of like the last 4 years. Buy the dips, guys. It's easy. After the W bottom we saw in 2011. And then in early 1969, the first bear market I had ever experienced surfaced. And it became clear to me pretty quickly that fundamental analysis was worthless in a bear market because analysts are human and they're stubborn and they stick to their guns and they're very slow to see the changes that are evolving in the marketplace. And I started a 45-year research project into technical analysis because I didn't think I could survive either psychologically or financially without something to lean on. And for me, believing in fundamentals, it was technical analysis. So in 1970, when the bear market was almost 2 years old and was about to end, I was sitting watching a New York Giants football game in my house in Staten Island, New York, looking at my monthly statement. And I was absolutely shocked that my account was down 70% and my clients were equally hurting. And I vowed that that would never happen again. How many of you have experienced that, in recent markets like 2000 and 2008? If you have, type a very painful why into the question box, please. And I see that so many of you experienced that. Well, my answer was technical analysis. So when the next bear market started in 1973-4, we were ready for it. They didn't have puts yet. That didn't come till 1977, but we could go into cash, we could short stocks, we could wait for deep oversolds and some indication of a bounce. And we survived that bear market and 8 bear markets yet to come. I then went on to a firm called Tucker Anthony in R.L. Day, where I headed up their options department. And here again, fine regional firm, pioneered the use of technical analysis with options trading. They didn't have many of the Greeks back then. For those of you who trade options, all these fancy ratios that have Greek names like delta and theta and gamma and vega. All we had was implied volatility, and I combined implied volatility with technical analysis, and we really knocked the cover off the ball. And then I left Tucker Anthony and joined Drexel Burnham, which is infamous for Mike Milken's junk bond shenanigans. But I was blessed at Drexel to work with George Douglas, who had one of the finest quantitative databases in Wall Street. And that's when I pulled everything together, technicals, fundamentals, and quantitative factors. And that's what you're going to see in the Chaikin Power Gauge rating today. Now, there's an interesting thread that runs through these 3 very fine firms. They were all preeminent in their field when I joined them, and not one of them exists today. But I'm still here on CNBC and Fox Business and quoted in Barron's and Market Watch. And the reason is that I've developed what I call a reality-based approach to the stock market. I recognize that fundamentals drive the market. I learned that from my big institutional clients. But I also know that you need technical analysis as a companion. Otherwise, you don't have the full picture. So this webinar is going to be about what I label reality-based investing. Now, just because I'm on CNBC doesn't mean you follow me blindly or anyone else who's on there. And there's some very smart people on there, and then there are a lot of people who do what's known in Wall Street as talking their own book. People who have bullish positions who come on and talk about them, or bears, particularly hedge fund guys who want to make you nervous and profit from their short positions. But Jim Cramer, who has become a big fan of Chaikin Money Flow thanks to the good offices of Bob Lang, gave this comment in September when La Quinta, which is a motel chain, reported a terrible quarter. He said, now look, I got La Quinta wrong, mea culpa. I should have been more skeptical and less willing to believe the CEO's exuberant bullishness and you could substitute a much more graphic word for bullishness because the CEO is conning people, including Jim Cramer, who's about as savvy as they come. But if now Bob turned Jim Cramer onto Chaikin Money Flow back in, I think, September. Uh, Jim was a client of my former firm, Bomar, where we use money flow, and he's become reacquainted with it. But put yourself in Jim Cramer's shoes, and you're looking at La Quinta and listening to the CEO, and this is sort of an advanced preview of what Chaikin Analytics is all about for those of you who are not familiar with it. We, on one chart, give you the fundamental view, which is on the bottom. That's the power gauge rating. How a stock is doing relative to the market. And you'll see in a few minutes how key and critical and important that really is. The Chaikin Money Flow, which was red, I got my jumpy mouse again, which was red, not green, indicating that the institutions were selling the stock as it was making this rolling top in the May-August time framework, and then sell signals in Chaikin Analytics. So if Jim Cramer, who's moving in this direction, becomes a true believer in Chaikin, he's going to be able to filter out some of the over-optimism that you get from some of the CEOs like Elon Musk, and in this case the CEO of La Quinta, because they're talking their own book in terms of promoting their own company stock. So the bottom line here is Jim Cramer is a really savvy analyst. I watch him every morning on CNBC, particularly in these volatile times. And he can get it wrong. So if he can get it wrong, I can get it wrong. And some of the talking heads who don't have the credentials that we have and the experience can really turn your head. And you want to be very skeptical about what they're saying because CNBC loves to put on people who create viewership, and the way you do that is having extreme opinions. So the poster child for that, sadly, is Dennis Gartman, who gets over $30,000 a year for his market letter. And no knock on Dennis. I wish I could get $30,000 a year for my market letter, but Dennis has gotten it wrong more times than the New York Mets. And he's on there all the time. You just have to have a filter. And what's your filter? Well, you're going to learn about that in the next hour. You're going to learn about a disciplined methodology that you can use in volatile markets. It's a 5-step methodology, and it works in normal markets, but it's absolutely critical in volatile markets. So let's look at the market a little more in depth so we set the stage for the volatility that you're going to experience in 2016. I've called the 2016 the year of living dangerously, and what I mean by that is we've got so many influences that are left over from 15 and new in 16. Future interest rate hikes. Every Fed meeting is going to engender volatility because there's going to be all this talk about will they raise, won't they raise, and that creates volatility. Commodity price is going to be absolutely critical. We saw that with the price of oil breaking to new lows, steel, terrible drain on emerging market economies. It's actually good if you're not a big fan of Putin and Russia because they're hurting and the Saudis are hurting because their current accounts deficit is really taking a hit based on lower oil prices. The dollar is going to be a huge influence in 2016. Why? Because a strong dollar is headwinds for international companies like Caterpillar and Nike and Honeywell and IBM. And it's not clear that the dollar is going to be strong in 2016, but that's going to create more volatility because that's not a market that a lot of people really have a good window into. Breadth divergences, we're going to get into that in a minute. What do we mean by breadth? Well, we mean new highs versus new lows and advances versus declines. At Chaikin, we have two very, very powerful proprietary indicators. Our power bars for the indices and the ETFs, and a unique and very powerful technique that I'm exposing for the first time. I've been sitting on this for over a year. It's been guiding my market commentaries, but I'm going to share it with you in a few minutes. And it is really powerful, and there's a good reason for it. And then finally, strong and weak sectors and industry groups. If you want an antidote to volatility, Focus your long positions on strong industry groups. They give you, as you'll see, a tailwind, and avoid long trades in weak industry groups and guessing bottoms, catching a falling knife, as Bob put it, because that's when volatility can really hurt you, when you're swimming against the tide. So what happens in 15 and what's happening in the stock market right now? Here's a one-year chart of the SPDR ETF, the most actively traded instrument in the U.S. markets, represents the S&P 500 large cap index. So 3 takeaways from this chart. Number 1, Chaikin money flow is your friend because it measures institutional buying and selling. And as the market was peaking in the summer, unable to break through 2100, 2130 on the S&P, Chaikin money flow stayed negative on these big rallies from lower volatility band to upper. That was a tip-off that there was something negative happening. We made that W bottom. Notice that at the middle of the W, money flow, even though we rallied 6.62% of the previous decline, money flow again stayed negative. This was some short covering, some wishful thinking. The institutions did not participate in that rally in a meaningful way. Then we came back down. In the cash index, we equaled the low of 1867 in the futures because we had that crazy market order Monday when all of us learned a big lesson about putting in market orders on ETFs when the futures are down 1,000 points pre-market. We made that W bottom. And by the way, W bottoms almost always are required if the market drops more than 10%. So you drop between 5 and 10%, that's a little bit of a correction, and usually you'll get a V-shaped bottom. That's what happened all through 2011 through the fall of 2015. And the question here is the selling pressure strong enough that we need a W bottom to make a low here? And I'm going to say no for the time being. I think that once the Chinese situation is resolved, once the Chinese government makes it clear that they're going to take a stand after the yuan reaches the level they'd like it to be, I think the market's going to move back up. It's going to be painful. We've got to respect it. It broke key support levels today. But we had another tip-off in Chaikin. Here's the power bar that Bob was referring to. Every day we look at the number of stocks that have bullish versus bearish power gauge ratings in an index, in ETFs, in any list. And what this does is it gives you a look under the hood. So what's been happening in the stock market? Well, the generals, the stocks they're affectionately calling the FANG stocks, are the large cap stocks like Facebook, Amazon, Netflix, and Google that have been leading the S&P to new highs, while the foot soldiers, the rest of the S&P, have been lagging behind. Now, how do we know that? Well, there are many more bearish than bullish power gauge stocks in the S&P. The fundamentals for the S&P 500 stocks, and now the small caps in the next slide, have been deteriorating since April. There hasn't been but 2 days since April when there have been more stocks with bullish ratings than bearish ratings in the S&P 500. So the power bar has been weak. And that means that the broad list of stocks is not participating. And now again, money flow failed to rally into green territory. We did pick up big sponsorship and accumulation as we were heading toward that top in late October. But since then, we've had a pattern of lower highs and lower lows. So I agree with Bob that the bottom probably wasn't seen at the close today, but volume has picked up dramatically, and we'll probably get a bit of a rally and then some backing and filling. And my view is there's opportunity in the marketplace. Now, is that opportunity in small cap stocks? Well, one of the key indicators in Chaikin for both stocks and ETFs is how are they doing relative to the market. So this is the IWM Russell Small Cap Index. Again, the power bar is weak, more bearish than bullish stocks. And the IWM has been underperforming the S&P, the SPDR, since mid-July. You made the same W bottom, which actually made a lower low. That's a weak sign. You got a pretty tepid rally, and now you're falling back toward new lows. In fact, we had recommended a put trade in the IWM if the market rallied the first couple of days of January. We didn't get that rally, so I can't take credit for that put trade, but we've already reached my downside target. So there's no sign that small caps are going to be your friend in 2016. Now here's the secret sauce that I was promising you. This is so powerful, and you can only get this at Chaikin because of the way we compute relative strength. Guggenheim pioneered what's known as an equal weighted S&P. As most of you know, the S&P is capitalization weighted. So Apple, Amazon, Google, which is twice represented in there, Netflix, Facebook, Amazon, have a disproportionate effect on the S&P 500 index. Guggenheim said, let's create an equal weighted ETF. It's got about $5 to $8 billion in it, so it's a pretty popular vehicle. And we run a relative strength, which is right here, of that RSP, Guggenheim equal weighted S&P versus the Spider. And guess what happens? Since late April, the soldiers have not been following the generals. You cannot win a war if the foot soldiers are not in the battlefield following the generals. Now, how do we know that? Because in the S&P, except for the 50 large cap stocks that dominate it, the other 450 have been in their sort of own mini bear markets to many people, the energy components particularly. So until the foot soldiers start improving and this relative strength line turns green, the market yet again is going to have another reason to be unable to break through resistance. Power bar and the relative strength of the equal weighted S&P. This is a really powerful technique. You can go to stockcharts.com and or Google and do a relative strength chart, enter Spider and then enter RSP, and you can see this. But it's very critical for the health of the market that breadth improve. And we look at conventional breadth indicators, but I like to have proprietary indicators that not everyone else is looking at. This is really powerful. So the sum total of all this is the markets have to prove themselves in 2016, and they are going to be volatile. And if you needed only one reason to know why they're going to be volatile, ex-China, it's the Fed. Because every 6 weeks the Fed meets, their open market committee, and every one of those meetings is going to create volatility and anxiety and anticipation. So what's our answer for all this? You need a rock to hold on to in a storm. And there's no doubt that we're seeing a bit of a storm here triggered by China. Well, for us, that rock is the Chaikin Power Gauge rating. It's a reliable indication of where a stock is headed over the next 3 to 6 months and beyond, as you'll see in a minute. It's simple but powerful. So I like to say that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And the reason I can say that with a high degree of confidence is that it's had a clear-cut record of success, as you'll see in a minute, of identifying the winners and helping you avoid the losers. And it's the sum total of my life's work, as I said. I worked with institutional investors for 30 years, learning what they did so that I could teach them how to incorporate technical analysis into their daily decision-making workflow. And based on that knowledge, looking over the shoulders of some of the smartest investors on Wall Street, like George Soros and Michael Steinhardt and Jim Paulson here in the 2000, and Fidelity and T. Rowe Price, I learned two things. They all use fundamentals to make decisions. It's the oddest of odd hedge funds that's only technically oriented. Everybody uses fundamentals. But they all have different approaches. You have value investors, earnings investors like a Jim Cramer. Warren Buffett would be an example of a value investor. You have people who look at more arcane indicators like short interest ratio and insider buying. Analyst estimate revisions are the biggest short-term driver of stock price movements, and they derive from earnings surprises. So Constellation Brands reported better than expected earnings. I think Bob talked about that on Mad Money earlier in the week. And because they reported better than expected earnings and raised their guidance, analysts are going to raise their estimates. And what do you think that does to the stock? It helps it move up even in a down market, as we'll see in the real-time Q&A session. So power gauge rating has been extremely successful. It became commercially available in January 2011 in the form of research reports on 5,000 stocks updated nightly based on the power gauge rating. And in that time period, the very bullish stocks in the Russell 3000 have averaged almost a 13% annualized gain, and the very bearish stocks have been up 1.5%. This in a period when the average stock was up 7%. So very bullish outperform very bearish, and that's really the key to making money in all markets, but particularly in volatile markets. If you stay away from the very bearish stocks in your 401k plan and in your options trading from the long side, and you focus on the very bullish stocks, but use the very bearish stocks for put candidates, you're going to beat the market. And you're going to sleep better at night because you're not going to be worrying about black swan events in stocks like Pioneer Natural Resources, which had a flash secondary that dropped the stock 10% overnight. Now, another way to look at the performance is to look at what happened in the last 12 months. And in the last 12 months, the very bullish stocks using the Chaikin power gauge rating and the Russell 3000 were down 1.29%. The average stock was down almost 8%, but look at the very bearish stocks, down 17%. These are the Kinder Morgans of the world. These are the Macy's of the world. You do not want to be in these stocks. So here's living proof that you can outperform the market by following a discipline. Now, a lot of our clients are traders, options traders, some are investors, some are professionals, and they don't hang around and wait indefinitely. They'll be nimble and take profits when they think it's appropriate. My wife is one of them. She has learned that there are some stocks you trade and some stocks that you sit in for the longer term as long as the Chaikin indicators are positive. So one final proof point. We formed a partnership with NASDAQ in April of 2014. NASDAQ stress tested the Chaikin power gauge rating for over 5 months. We're very happy with what they learned and asked us to create 3 NASDAQ Chaikin co-branded indexes. You can quote them every second on Google Finance, CNBC, Reuters, or Bloomberg. But there was a big proviso. We couldn't change the portfolio for 12 months. Now imagine in these volatile times sitting with a portfolio for 12 months, not being able to take a loss, take a profit, readjust. Well, that was the ground rules that we were asked to follow. We did. The portfolio was rebalanced on April 1st of 15. In the 21 months since these 3 NASDAQ Chaikin indexes have been in the marketplace, they've each outperformed their underlying NASDAQ benchmark. What that says to me is not only is the Chaikin power gauge good for options and swing traders in that 3 to 6 month time horizon, but the factors are so pervasive that these can be viewed as buy and hold portfolios. And that's one way to counteract volatility. The studies show that if the average mutual fund is up 9% a year, the average investor in mutual funds is only up about 5%. Now, what do you think that is? If you think you know, please type a Y in the question box. The reason is that people are human and they're affected by the headlines and what they hear on CNBC and Fox Business. And they'll sell out just at the wrong time. There's a virtue in having confidence in an indicator that's fundamentally based that enables you to weather the storm. Now, you always have to use some sort of money management. You don't want to lose too much of your money in any one position. But the fact that there is an indicator out there that measures fundamentals that has proven itself as a long-term buy and hold indicator gives me confidence. Now, it gave First Trust, who's the largest creator of unit investment trusts, a lot of confidence because on December 7th, First Trust Portfolios launched the Chaikin Low Beta Growth Portfolio, S&P 500 only stocks, where the Chaikin methodology was used to create the portfolio. And that 20 stock equally weighted portfolios beating the S&P by 100 basis points since it was launched on December 7th, proving once again that you can identify potential winners even in volatile and down markets. So here's an actual chart of that, and it highlights something that's really important. Our small cap index for the 21 months has been up 4.55%. The NASDAQ 1500, which is equivalent to the Russell 2000, was down 3.5%. Wouldn't you like to be up when the market's down? I know my wife Sandy duplicated these. Her portfolio was up 5% in 2015 versus a 1% drop in the S&P. Now, I've overlaid these power bars to show you how powerful the power gauge can be. This NQUSCHK was created on April 4th of 2015. That's over 9 months ago. In that 9-month period, only 4 of the 215 stocks have turned bearish. If you look at the Russell itself, which is comparable to the underlying NASDAQ index, you've got 405 bearish stocks versus 270 bullish stocks. I want you to leave this webinar believing that there is a better way, that there is a disciplined methodology, because a disciplined methodology is your friend in volatile times. So here's the Chaikin method distilled down to a pyramid. The top of the pyramid is the power gauge rating. Looks like the gas gauge on your car. It's very simple to understand. And industry and sector rankings. Those two fundamentally driven factors will put the odds in your favor. At the bottom are 2 only technical indicators, Chaikin money flow and Chaikin relative strength. Now, Chaikin money flow you can get on stockcharts.com, Thinkorswim, any of your brokerage platforms. Chaikin relative strength is proprietary. And in the middle are buy and sell signals, and we all know how important they are for options traders. So volatile markets demand a disciplined method. And we're going to show you a 5-step method to take advantage of the Chaikin indicators to help you make money in volatile times. First one is to find bulls and bears with Chaikin power gauge rating and Chaikin relative strength. We call that combination the dynamic duo. And it leads to what we call classic Chaikin bulls. And we're using Activision Blizzard as our classic bull. Power gauge rating needs to be bullish. Stock has to be outperforming the market. And we want Chaikin money flow to be strong. So here's what that looks like on a 1-year chart. Bottom of the indicator, the bottom indicator is the Chaikin power gauge rating. You can look at it and decide for yourself whether this works for you and your trading style or your investment style. And it's clear cut. Day by day, week by week, Activision has had a bullish rating. The stock has gone from 18 to almost 40. And money flow has been strong. It's been outperforming the market. This is a classic Chaikin bull. And along the way, we've had signals. In this case, oversold buy signal. Now, how many of you think that signals have to be complicated? If you do, type a Y in the question box. Because I'm here to tell you that signals should not be complicated. They should be easy to understand. They should be logical. And here's the underlying rationale for this. This is all on our website, no black box, fully disclosed. I learned this from Larry Williams, who was a mentor to me when I was creating Chaikin Money Flow, not directly, but through his book. A couple of years ago, he detected a pattern, because he's all about patterns, that was very effective. And he basically said if a stock's in an uptrend and makes a new 8-day low, you want to be a buyer. It's what's called a low-risk entry point. It's not precise. We took it one step further because we're really all about skewing the probabilities. We require that the stock have a bullish power gauge rating, get oversold, and make an 8-day low. Now, 2 out of 3 of these will work, and the time duration is 5 to 10 days. So this is ideal for people trading short-dated options. It's not something I endorse, but I recognize that you can make a lot of money very quickly. It's also good for swing traders because they're great entry points. They're also good entry points to add to a long position in your 401k plan because you're buying on weakness, and my instincts have always been to go against the crowd. Now, what is a classic Chaikin bear? It's the exact opposite. Power gauge rating is bearish. Relative performance is weak. Chaikin money flow is weak, indicating that the institutions are selling, not buying the stock. It's red, not green. And Kinder Morgan is our poster child. For over a year, Wynn was our poster child. And you'll see a chart of Wynn Resorts later in the presentation, but I thought I'd change it up. Here's Kinder Morgan in the energy sector. It was a darling. Power gauge has been weak, and the stock has been underperforming the market. And along the way, you've gotten a series of sell signals. Now, Kinder Morgan got up around 50 at its high. And some of these sell signals came in the 30 and 25 level. And I've heard a lot of people say, well, it's too late to short that stock, or I'm going to stick with my long position because it's already down 50%. That's total hokum. It's never too late to sell a stock if the factors are lined up against you. And here's a perfect example of it. Now, how do you find these stocks? I'm fighting a cold, so you'll have to excuse a couple of water breaks. Well, we've got Chaikin hot lists. We've got featured bulls and bears, and then we also have stocks that have turned bullish or bearish this week. So we're doing some of the work for you. But you can also take advantage of our new stock screener. I know Bob Lang has really seen the light and is using this very aggressively because I see all the lists that he's had in his Chaikin system. So what I did here was I took the Russell 3000, and we'll demo this in the real time, so I won't spend too much time on it, but I wanted to find bullish candidates. So I said the power gauge rating had to be bullish. It had to be in a rising long-term trend with strong money flow and relative strength, and I wanted just large and mid-cap stocks. And I filtered the Russell 3000 down to 20 names. And we're going to see some of these stocks. Bob was talking to me about Dr. Pepper Snapple, which I think he talked about on CNBC, in the beverage sector, which has had a bullish power gauge rating. First Solar, as you'll see, the premier blue chip in the solar sector, and Goldman Sachs just recommended it, pushed it up to a new all-time high. Valero in the energy sector, one of the only energy stocks going up. Atmos, which is a natural gas distributor. Look how easy it is to put yourself in the driver's seat using Chaikin Analytics. When you see this in the real-time demo mode, you'll just be blown away because it's so fast, so personalized, and so powerful. So 2 ways you can find these stocks. But let's look at some specific examples of what we call the dynamic duo, which is the combination of the Chaikin power gauge rating and Chaikin relative strength. This is my reality-based approach to investing, and I'd like it to become yours. Why? Because it works. So the dynamic duo finds big winners and losers. Superior returns come from stocks that outperform the market. Doesn't mean you have to be a momentum investor. This can be in value stocks as well as high momentum stocks. But there's one key thing to understand, and we'll see an example of it with Amazon. Relative strength stands alone as a bullish or bearish indicator. So if the power gauge is neutral and a stock like Amazon starts outperforming the market, or Walmart, as it did briefly in the fall of 14, if you're a momentum investor, that's okay. You can trade in the Teslas of the world and the Amazons, but just be aware that if the fundamentals are not supporting it, if the power gauge is not bullish, you're on a high wire without a safety net. And we all know what happens when you fall off a high wire. And how do you fall off a high wire in a momentum stock? Well, styles change on Wall Street. 3D printing stocks were all the rage, and then they weren't. Cloud computing stocks were all the rage, and then they weren't. Energy stocks, fracking stocks, drillers, all the rage, and then they weren't. If you're not sitting there with a safety net, and that safety net is the power gauge rating because the fundamentals do drive the market, you've got to have fabulous risk management and money management techniques, but more often than not, they fall by the wayside and you take a big fall off the high wire. So here are two examples of the dynamic duo. First Solar, which I know Bob likes, and as importantly, Goldman Sachs likes, reported better than expected earnings back in October, was the beneficiary of a rider to the budget bill that was passed in Congress, which extended the credits for solar panels a couple of years that were due to expire, and then was put on Goldman Sachs' buy list just 2 days ago, and it spiked up over 70. But look where the power gauge discipline would have gotten you. Power gauge turned bullish in August, but the stock was underperforming the market. Turned bullish again in beginning of October, still underperforming. Negative money flow, not as bad as it had been. W bottom, mirroring what happened in the S&P. And then you broke out of the downtrend, and it started outperforming the market in mid-October with the stock at about 52. And look at the money flow since then. Money flow has never wavered. Even when the stock dropped over 10% twice in that period, closer to 15%, money flow stayed positive. That's a particular pattern that we call stealth accumulation, and we're going to show you some examples of that and explain why that works. But the bottom line is, First Solar is an example of the dynamic duo. Relative strength and money flow are strong. This is a stock you want to try and buy on weakness. Goldman creates big demand when they put a stock on their buy list, and now the stock's pulled back and filled that gap. 65, 68 when I pulled this chart earlier today. These are the stocks where you can take advantage of volatility. You got a stock that's down 8% in 2 days, that's volatility. But it's an opportunity if you're following a discipline. So what do we want to see happen? Well, we'd love to see the stock get oversold, money flow stay positive. We'd like to see it pull back to its 21-day average, which is at around 64, and then we'd step in and buy it, particularly if the market is showing signs of stabilization. Now here's the dynamic duo on the downside. Potash, one of the biggest fertilizer stocks in the world. The agribusiness group is weak, and we show you that here. We characterize the industry groups based on the power bar. And potash has been a total disaster. Relative strength turned negative in February. Power gauge turned bearish about a week later. Institutions were already selling the stocks, and along the way we kept getting these money flow sell signals. Now, what is a money flow sell? It's a stock with a bearish power gauge rating, so we've already put the wind at your back. That moves above a short-term moving average at a point in time that it's been underperforming the market and then drops below that moving average. Think 8-day exponential average. Moves above it, drops below it, money flow sell signal. Look how profitable these would have been. If you were stuck in this stock, you could have used this as an impetus to take your loss. But more importantly, in a bear market, which is inevitable sometime, these are great put buying opportunities. So here's a stock that's down from 36 to 16, and at the 22 and 20 level, you got sell signals. Yet again, people say, too late to sell the stock.
Mark, I just wanted to make a comment because it's really important that you, the point you're making here is that, much like you said earlier, it's never too late to sell a weak stock. So somebody could look at this thing at $35, $36, and then it's dropped to 24, and they're thinking that they've lost all opportunity. I recall, and I just think that's wrong. You just got to go with the trend. And I recall the last webinar we did, the example you brought up was Win. And I think it was in the, I want to say it was in the 150s or the 180s or something like that when you got a sell signal, and it didn't go all the way down to like the 50s, and there was a sell signal. I mean, literally all the way down, right?
There was, and
And
we're going to look at that chart in a minute because Win, especially on CNBC, has been the subject of a lot of guessing of bottoms. You know, casino stocks are going to do better. Well, if the Chinese economy is weak, you can be sure Win isn't going to do very well because they've already got one casino in Macau and they're constructing another one. And if the Chinese are hurting, they're not going to Macau to gamble. So structurally, Win has some problems. But you're absolutely right, Bob. The market dictates what you do. Now, there does come a point, and Green Mountain Coffee is a good example of it. We actually used it on our last webinar with Bob. It was the gift that kept on giving all the way down to, I don't know, $25. But ultimately, someone thought enough of it to make a takeover bid. And that's going to happen. So you've got to be careful. And if you're using put options, you've got a built-in money management discipline because you can't lose more than the cost of the put. If you sold it out of your portfolio, that's why we always say, as soon as the power gauge turns bearish, just get the red out, sell it. It's like Visine for your portfolio. Then you don't have to worry about where the bottom's going to be and whether you're going to get bailed out by a takeover bid. Sure, takeover bids come. There was one stock that I made my bearish stock of the week, said to buy puts, which was Starwood Hotels, HOT, and because they were due to report earnings, and the stock was very weak, and we all know that Airbnb is eating the lunch of the conventional hotel chains. And guess what happened? The day earnings were due out, takeover bids, rumors surfaced, and the stock spiked up 20%. That takeover bids never materialized. First it was a Chinese company, then it was going to be Hyatt, then it was going to be Marriott. Bottom line is HOT is back down below the price where we said to short it. Now the people who bought put options ahead of the earnings, which were weak, took a hit, but they didn't get killed because the loss was restricted to the cost of the put. And we actually said consider re-shorting this because this looks like a fake move, but that's neither here nor there. The bottom line is nothing works all the time, and you need a money management and risk management discipline to protect your capital, especially in volatile times. So the second discipline is to look for strong and weak industry groups. Strong groups give you tailwinds. It's been documented by Zacks, Investors Business Daily, Standard & Poor's over a 30-year period. Strong stocks and strong industry groups. And most of these services measure them by price momentum. We look at relative strength and the power bar. But strong stocks are where you want to be on the long side, and weak stocks and weak industry groups and sectors are where you want to be on the short side. Now, we rank the 9 sectors, the 9 select spider sector ETFs, which I know many of you trade, by power bars. Right now, the market is defensive. It's been defensive for 2 weeks. How do we know that? Utilities, the only industry, or sector rather, in the S&P with more bullish than bearish power gauge ratings, 12 to 0. Healthcare, considered a defensive sector even though it was big upside driver last year. Consumer staples, the classic defensive stock, food, beverages, tobacco, and technology sort of sitting there better than the S&P in terms of the power bar, but not with a bullish power bar because there are more bearish than bullish stocks. But let's look at the XLK, the technology sector, because it was outperforming the market. How do we know that? Relative strength indicator is green. I really apologize. I keep saying I got to get a new mouse, but I've got an Apple mouse that is faster than a jackrabbit. So here's the XLK over the last year. It's actually performing better than the market, even with today's sell-off. But under the surface of this outperforming index, you've got a bearish power bar rating, and you've got stocks in there that are doing different things. Now, Google is one of our favorites. I know Bob Lang had a great trade in explosive options in Google ahead of the earnings. Power gauge turned bullish right after that. We didn't capture that trade, but we've been bullish ever since, and it's been outperforming the market. So if you're looking at technology, Google is a place to be focusing, and you had a nice 3% decline today, back down to 738. That's near support at the lower volatility band. It's where it found support the last time. I think it was 733 was the low. So Google should be on your watch list. Take advantage of the volatility in the market to enter Google. It's hard to buy when the market's moving up. But by all means, avoid Apple. Now, we've been saying this consistently since July. Apple is overowned. People like Jim Cramer, who own it in his foundation, are finding excuses to like it. There was an analyst on CNBC today who said, I've got a price target of 200 on Apple, from a fairly respected research firm called Drexel Hamilton. And Joe Kernan excoriated the guy. He said, how can you say that? You can't just take your earnings estimate, multiply it by 16, add in the cash, and say that's where it's going. He said, what are you telling your clients when it's dropping from 134 down to 100? And we saw that coming. How did we see it coming? Well, it started underperforming the market. And we started getting these relative strength breakdowns, and then the money flow started to weaken, just as it did in the top area here, where it should have been green, it was red. And there's a good reason here. Apple is overowned. Everybody who wants to own Apple already owns it. They put it into the Dow Jones averages in February. That was the kiss of death. After the stock had doubled to 130 plus, they put it into the Dow Jones averages. And there's no new product on the horizon that excites people. So you can rationalize away all the cash and the stock buybacks, but the bottom line is the market tells you what you need to know. And the market is saying this is not a place to put your money. Can it bounce? Sure, Bob.
Mark, I was just going to say it's interesting that the recent story with Apple has been, maybe they cut their guidance for the 6S phones, and some of their suppliers are saying the same thing, that they're going to have weaker quarters. Even Corvo came out tonight with a weak guidance. But you didn't really need to wait for that news to hit before you got short the stock, did you?
No, absolutely not.
Right.
Look at these sell signals. Relative strength breakdowns. Stock periodically gets overbought. If you get overbought with negative money flow, as you did in December, run for the hills. You made a lower high, under support, under resistance, negative money flow. It's all there for you. You could find all these things, except for the power gauge rating, on FinViz, Yahoo Finance. But it's all here for you in one place, because time is really our most precious commodity. And we don't have enough time to visit 5 different sites to make an options trading decision. It's all here in one spot. So looking at groups and sectors a little more closely, the retailers have been underperforming, even while consumer discretionary has been a strong performer. And retail stocks are in the consumer discretionary group. But consumer discretionary has been over-influenced by the hype stocks, Amazon and Google, Facebook, Netflix. Bottom line is, retail has been a disaster. And you know that from the relative strength. It's been underperforming the market since July, with a number of sell signals along the way. And it made another new low today, which means that you got to avoid stocks like Macy's. Now, Macy's had a money flow sell signal just 3 days before they reported earnings in November. The earnings were a disaster. It was followed by Nordstrom's disaster, Urban Outfitters the following Monday. But following this Chaikin methodology, you should have been out of the stock when the power gauge turned bearish in July up there at the 66 level. But you follow these sell signals and you can take advantage of volatility during earnings season, and we're going to talk about that toward the end of this presentation, to really make money when companies disappoint, because this stock dropped over 22%. But the group work for the XRT would have steered you away from all of the retailers. Now, energy continues to underperform. The relative strength on energy turned bearish so long ago that I can't even find it on the one-year chart. It was back in September of 14. There have been periodic rallies along the way when crude oil went from 40 to 60 in March, and then again when it rallied in September, October. The relative strength has never wavered. There's no indication yet of a bottom in crude. Will it happen sometime in 2016? Probably, but why guess? Just avoid energy stocks like Pioneer Hybrid. We mentioned Pioneer Natural Resources. We mentioned that a little earlier. Power gauge had been bearish. You picked up a lot of buying interest, money flow. These are the value people thinking the stock had bottomed out. Then the power gauge turned bearish again in mid-December with the price at about 140. We got a sell signal, and then a day later they had a big secondary offering. They're hurting for cash. They needed to raise cash, so they sold a big chunk of stock, over 10 million shares. And the stock was down 8 points that day. If you follow the discipline, you're not even involved with Pioneer except as a potential short sale. And the group and sector work reinforces that. And yet again, we have Macy's as another example. Now, the third sort of step in this discipline methodology is to use personality changes in Chaikin money flow to anticipate volatile moves before they happen. So what is a personality change? Well, A, it's the key to making and keeping profits, and you have to learn how to spot personality changes. You don't want to be on the wrong side of that door when Jack Nicholson's coming through with the axe. We define a personality change as a stock that goes from outperforming the market to underperforming, or vice versa. So the relative strength indicator, this heat map, goes from red to green. That's a bullish personality. Green to red, it's a bearish personality change. And the reason it's important to spot these is they can tip you off in advance to where the big money is headed. So energy, we know, is making new lows, but Valero and Tesoro are actually been very strong stocks in 2015. Tesoro was the only bullish stock in the S&P 500 with a power gauge rating that was bullish in 2014, and these stocks have been good performers. Oil refiners who benefit from the price of crude oil dropping. So here's your bullish personality change back in January of 15 when Valero was about 55 on its way to 75. Now, if you absolutely positively had to own an energy stock, this and Tesoro were the ones you wanted to own. Now, here's an example of a stock with a bearish personality change. Legg Mason, big money management firm, lots of bond assets. Look what the institutions have been doing. Based on what you've heard on this webinar, looking at Chaikin money flow, type into the question box a big Y if you can see how powerful Chaikin money flow is at measuring institutional buying and selling. If you come away from this with nothing but that, you're going to improve your trading results. Legg Mason has been under distribution since March. And in early April, you had a bearish personality change. The stock went from outperforming the market to underperforming. The power gauge turned neutral. It never turned bearish. But this combination of Chaikin money flow and relative strength is also a dynamic duo in and of itself. And this all took place in the 53.4 area. Stock closed at 36.21 today, down almost 4%, made another new low. And then our final example of a personality change is a stock we alluded to, which is Amazon. Power gauge has been neutral. It had been bearish, but the stock reported better than expected earnings in late January of 15, and it's been on a tear ever since. It's sort of giving up some of that right now, down 4% today. But Amazon went from 350 to almost 700, and along the way you got some relative strength buy signals. This is the last one I'll explain of the 6. This is a powerful signal. Why? Because the time duration is typically 4 to 8 weeks. So imagine the money you could make knowing that with a 2 out of 3 probability, you've got a stock that's likely to go up over the next 4 to 8 weeks. There's a lot you can do in options and stocks with that kind of knowledge. So how did that signal get triggered? Well, it doesn't care about the power gauge, but it does require that the stock be outperforming the S&P. And then we want it to get oversold, drop below its 21-day exponential, and when it rises back above its 21-day exponential, that triggers this relative strength buy signal. To me, this is the most powerful signal in Chaikin analytics. Now, even a signal like this is going to have a hard time bucking a market panic. So better to go into long trades when the market is on solid footing and look for short sales when it's not, but this is a really powerful signal. Now, we talked about a special pattern with Chaikin money flow that we call stealth buying and selling. The reason is institutions are so big these days, they take a long time to execute their orders, and they're paranoid about other people knowing what they're doing, so they fly under the radar screen. Here's an example of stealth accumulation. Red Hat, open source Unix software. The stock started moving up in September, and look at that money flow. So that when Red Hat sold off from 83 all the way down to 77, money flow stayed positive, and you got an oversold buy signal because you made an 8-day low. If you believe in this discipline, you're going to pull the trigger on those buy signals. If you don't have a discipline, any discipline, you're just going to sit there saying, wow, that looks like an interesting trade. And you can't make money sitting on your hands. If you've got a discipline, you believe in it, you're going to have conviction, and conviction leads to profits. Not every trade works, but this is stealth accumulation. Here's stealth distribution. Pretty painful. Nordstrom. Notice how money flow stayed negative from April through September. Now, this is a 21-day money flow measurement. And you had a rally in Nordstrom from 70 all the way to 78 over a 4-month period, a 4-week period, and money flow never got green. That was a sign that the institutions were selling the stock, not buying it. Now, you might say, well, how can a stock go up 10% if the institutions are selling? Well, that's the way Wall Street works. Supply and demand. The institutions will hold back until they think the stock is peaking if they see buyers. Bottom line is, money flow should confirm price. And it didn't. You had 3 sell signals. The stock reported disappointing earnings right after Macy's reported, and the stock dropped from 63 all the way down to 50. This is how volatility can work in your favor. During earnings season, when most people are nervous, you can be confident. And now Twitter, one of the former favorites that's taken it on the chin. 4-week sideways movement back in May through August. Apologies for that. Money flow stayed negative, even though the stock had some periodic rallies. You had some sell signals. That told you that the next volatile move was going to be to the downside. Bearish personality change, dynamic duo of relative strength and Chaikin, power gauge rating bearish. Everything was lined up. If Warren Buffett shorted stocks, he would have been shorting Twitter. I guarantee it. Everything was stacked against them, and you had these signals, and you continue to have signals, and you had a signal just 3 days ago, a money flow sell signal with the stock at about 22.5, and look what it did today. It was down almost 5% to $20. These can be profitable trades. Short sales, puts, But you certainly don't want to stay long stocks like this. You've got to recognize these personality changes in volatile markets. Don't put your feet in cement. Be flexible, let the market dictate, and these indicators measure the market. So now we'll talk about volatility in earnings season, because you can really make money big time, as you saw with Macy's and Nordstrom. So we love this graphic, winning plays during earnings season, because when they work, it's like a long bomb in football. So the classic example is Netflix. This is October of 2014, over a year ago, when Netflix dropped from 460 to 340 after a negative earnings report. That negative earnings report was preceded by an overbought sell signal, and we highlighted that as a bearish stock of the week. And people who bought out of the money puts made ridiculous returns 50 times in a day. But saner people also made money. Quick $21,500 profit using the upcoming earnings ideas in Chaikin. Netflix had a very bearish rating, bought 3 put contracts before earnings on 10/15 for $22 and sold them the day after earnings for $93.90, a quick $21,500 profit. So now let's look at some other examples of how you can take advantage of volatility during earnings season. Here's a stock called American Woodmark. Small to mid-cap stock, third largest kitchen cabinet manufacturer in America. Classic bull in Chaikin, bullish power gauge outperforming the market. Sell signals along the way, almost every one of them worked out, but right before the earnings were reported in late November, the stock took a tumble on a Friday. It dropped from 72 all the way down to 64. And it was hard to find the reason. My wife Sandy owned the stock. She had been trading this successfully for over 9 months. And I finally found that a firm called Baird & Company, based in Milwaukee, good research firm, had downgraded this from outperform to neutral. And an insider who had been selling the stock in small lots for the last year and a half continued to do that. And that was enough to spook the market. Now, if you didn't have the conviction and the Chaikin methodology to believe in, you might have been spooked out of that stock. But guess what happened when they reported earnings the following Tuesday? The stock reported better than expected earnings, raised guidance, and it went from 64 all the way to 87. That's why you need a disciplined methodology, a beacon, something you can count on that's objective, not emotional, not subjective, not a Baird analyst saying this or an insider service saying that, but something that parses all this information and distills it down into a rating. Whole Foods, the gift that keeps on giving on the downside. Bearish earnings reports preceded by a relative strength sell signal and a big gap down, and then big continuation move. Now, Whole Foods looks like it's formed a bottom or a base. Money flow is coming into it. Relative strength has not yet turned positive, but the money's been made. Look at these. Every 3 months, you had a chance to make money on the downside. 3 times on this chart, volatility was your friend ahead of earnings, and that's going to continue because human nature is always the same. You see a disappointment, you rush in and sell the stock at the market. It creates a gap, and if it's a serious problem, then it just keeps going. Urban Outfitters, we talked about. Terrible retailing group. Company can't get its act together. They actually bought a high-end Italian restaurant chain here in Philadelphia where they're based. God knows what they're thinking. If they think that a pizza restaurant chain is going to turn around a clothing retailer and a home goods retailer, they're just smoking pot, in my view. But there was plenty of money to be made by buying a put option on Urban Outfitters ahead of the earnings report. And you already had Macy's and Nordstrom's that had reported. So there was every clue in the world, even outside of Chaikin, that this was an opportunity to take advantage of potential volatility. And then finally Yelp where we made this our bearish stock of the week back in July when it triggered a money flow sell signal just 3 days ahead of earnings. It had gapped down twice in the two previous earnings reports by about 18%. This time it went down by 28%. And we actually had clients who made, as you'll see in a testimonial at the end, a lot of money with put options on Yelp. So the final step in this discipline methodology to conquer volatile markets is to play good defense. Avoid the landmines that destroy portfolios. Particularly important in 2016, the year of living dangerously, in my view. But good defense can also lead to good offense, as we'll see. The watchword here is it's the stocks you don't own that matter. This is a quote from someone who wrote for CNBC and TheStreet.com. Very, very smart guy. And he wrote an article in January 14 saying, doesn't matter how many winners you pick, if you let the losers drag you down, your portfolio is going to hurt. I think Bob Lang knows this guy. He's now doing short sale research. So here are some examples of stocks that you do not want to own. Chipotle, real sad story. E. coli, people are getting sick. Nobody wishes that on anybody, but the stock is suffering because of it. Jim Cramer said he went into a Chipotle up in Boston when he was visiting his daughter at Boston University, and there was nobody in the place. Well, what do you expect the stock to do if nobody's in there? Same-store sales are going to drop, and who knows where the bottom is in Chipotle. Play good defense and get out when the power gauge turns bearish, and don't bottom fish. Wynn Resorts, which Bob talked about, and there's that short sale which we talked about on a previous webinar with the explosive options people. The stock was 100, down from almost 200. Power gauge turned bearish at 195. But right before earnings, you could have shorted Wynn, betting that they were going to yet again disappoint because of trends in Las Vegas and Macau. And sure enough, the stock dropped from 100 all the way down to 70, with an ultimate low in the mid-50s. Now, there's been talk on CNBC yet again that Wynn is regrouping, that Macau is turning around. Well, look what happened today. Coming into today, we had two sell signals. You could have found them on our alerts dashboard. A reversal sell and a money flow sell. And Wynn was down 9% today. Follow the indicators, let them be your guide, play defense, and you'll survive volatile markets, you'll survive bear markets, and you can turn volatility in your favor by buying put options on stocks that are weak, turning what we call landmines into gold mines. And then Sun Edison in the solar sector, we looked at First Solar, which is the blue chip, well capitalized, making money. Sun Edison is the poster child for the hype in the solar industry. I put that arrow when the stock got overbought because here's stealth distribution. The institutions didn't play that rally from 6 to 11. And we got another sell signal here just 5 days ago with the stock at about 550, and today it was down 30% to 380. So again, it's never too late to sell a stock. If you're stuck in it, don't wait for it to go to zero. This company could easily go to zero. That's what the market's telling you. Power gauge is bearish, underperforming, institutional selling, breakdown from a big extended move. These are the volatile moves that can kill you if you're on the wrong side of them. And then finally, very mundane, the rails, the transportation index has been a lot weaker than the Dow and the industrials and the S&P. And the rails are part of the reason. Union Pacific made another new low today. This is the kind of stock you need to avoid in volatile markets. There's nothing that can help the rails right now. They're not transporting as much oil. They're not transporting as much coal. Manufacturing activity in the U.S. is contracting. So you've got negative relative strength, negative power gauge rating, negative money flow. Do you want to be positive on this stock? No. Just avoid it. Play good defense. So now you know how to use a disciplined methodology in volatile markets. What are your next steps? If it were me, I would sign up for Chaikin Analytics today, and I'd like you to consider that. Reserve your professional training session. We're all about getting you up to speed so you can make money quickly and apply this methodology early enough in 2016 so it makes a difference. Start getting our daily and weekly market insights. My associate John Schlitz is one of the best market technicians in the business, worked at Lehman Brothers when it was a good firm, has worked with me for over 20 years, and every morning before the opening he analyzes the markets, tells you what's happening pre-opening, and gives you an idea for the day. And then I write the weekly market commentary that we started the webinar off with. Apply this Chaikin methodology to your nest egg today. So Chaikin Analytics can be your GPS for volatile markets, and it now includes this powerful stock screener and a module called Options Play, which demystifies options trading. It helps you zero in on probability-based strategies for the stocks that Bob Lang or your own research is finding as attractive options candidates. It takes some of the drudgery and the mystery out of options chains and Greeks and simplifies it based on probabilities in the same way that Chaikin is based on probabilities. So here's a trade that I recommended in my weekly market insights. I expected the market, as I said, to rally the first couple of days of January. And based on that, I said if IWM rallies 1.5 to 3%, put on a bearish position. And in this case, Options Play gave me a beautiful spread, the 113-108 vertical put spread. Had a good probability risk-reward ratio, limited risk, the cost of the spread. Unfortunately, China came into play and we never got the rally, so I can't take credit for this. The idea was right, but couldn't really implement it. But it's already reached my target. It's down today in the 107 range, whereas on Friday it was 112.62. So there'll be another time and place, but the point here is the combination of good technical analysis and options play helped me zero in on a very, very profitable options strategy. And the sum total of it is we got this wonderful testimonial. Thank you for making my life easier. I'm writing to tell you how absolutely incredible Chaikin Analytics has become. It started great, but with the options and screener additions, I feel it's absolutely the best product on the market. I've recommended your product to all my investing friends. It doesn't get any better than this. So thank you, JD. And this came in November right after we introduced the screener. So Chaikin Analytics is normally $1,950 a year for iPad and desktop with screener and options play built in at no additional cost. As a webinar special for the explosive options community, we're reducing the price to $1,750, taking $200 off. You can go to chaikinanalytics.com/exclusive, and this offer expires Sunday, January 10th. Or you can contact sales at chaikinanalytics.com. And I know, Joe, you'll be typing the link in where you can automatically see the discount pre-populated in our checkout cart. Now, what do you get for $1,750? Well, you get to turbocharge your profits and deal with volatile markets in an intelligent way. And you also get $995 in added value. The Market Insights newsletter and our portfolio health check and research reports normally sell for $495 a year. And the options play module, if you bought it on your own, would be about $400, $500. So this is a $995 added value. You get our weekly Market Insights newsletter, stock screener, and options play fully integrated. Here's the key: free small group coaching sessions. Joe Bicella, who is our webinar organizer. We'll help you learn all the features, Chaikin Analytics, and how to use them and get you up and running quickly. And then we have free subscriber-only open forums, bi-monthly Q&A sessions where you can ask questions, and John Schlitz's daily morning insights. And by the way, John pointed out on August 24th that the futures were down 1,000 points. You don't have to watch CNBC incessantly to know what's going on if you read John's morning insights that come in your inbox before the opening. So one more testimonial, invaluable service. Mark, I make a living trading, and you're an important part of my trading process. My results have never been better thanks to you. The edge and confidence I get in my trading is greatly enhanced with the use of Chaikin Analytics. A serious trader looking for increased productivity, confidence, and added edge will find your service invaluable as I have. And this is typical of the way people are using and reacting and responding to Chaikin Analytics. So we looked at that Yelp trade back in July, and Mike T, who was a relatively experienced options trader, had only been a Chaikin subscriber for 2 weeks, but he said, I netted $17,400 profit this morning based on your bearish call on Yelp. I've only been a subscriber for 2 weeks, and I'm finding more success than I have the rest of the year. And based on that bearish play of the week, I risked $7,000 and netted $17,000. Now, Mike was an experienced options trader. I think he sent us his interactive broker statement. But with our new options play module, you can take Bob Lang's ideas, you can take your own ideas, you can find stocks within Chaikin, and immediately find an intelligent option strategy based on probability. So it's a complement to what Bob's doing in his trading room. It's a way to find options ideas on stocks that Bob may not be covering, because one person can't cover 5,000 stocks. Bob does a great job finding big winners, but there are other opportunities out there. So this is a nice complement to what Bob Lang is doing in explosive options. And by the way, Bob's going to be presenting to our group next week, so please take advantage of his knowledge and come on that webinar as well. So if you believe in Chaikin Analytics, my question to you is, will you be our next success story? Will your testimonial be in my next webinar deck? If you believe that, we've got one final inducement, a fast action bonus to encourage you to subscribe to Chaikin Analytics. If you subscribe by midnight tonight, we're going to take an additional $100 off, reducing the price to $1,650. ChaikinAnalytics.com/explosive. That offer expires at midnight tonight. And I'm sure Bob will have some words of encouragement, because I know how much he believes in this. So Bob, a couple of final words, then we're going to turn it over to Joe Bacella for the Q&A, or if you've seen any questions that people have, I'll be happy to answer them.
Yeah, there's a couple of questions. But first of all, I just wanted to thank you for spending the time with everyone, and it's an absolute treat and delight to have you here. And I know you do speak a lot to other people, and I could just tell. I'm sure everybody can hear the passion and energy in your voice when you're talking. I know you're a little bit of a cold, but still. I remember, Mark, when we first did a webinar together in June, you had just flown to San Diego, and I think you'd just been off the plane for a couple of hours. You got to the hotel, and you spoke to the group for well over 2 hours. I was awe-inspired by listening to you and that energy that you have and the passion that you have for trying to help people, and that's what it's all about. You know, I do a lot of these webinars with other people, Mark, and I really tend to gravitate to people like you who want to help people get better, and that's what it's all about. We're just trying to help people get better and help navigate. And I think the question that you asked early on, when you asked, you know, are you befuddled or are you lost, or when most people, I said 70% of most people said they were befuddled, they were having trouble trying to figure out what's the next step is, the analytics are the first step to taking the next step. That's
Well, thank you for that, Bob. And here's an example of a stock that I think you saw unusual options activity in. PMC Sierra
yep.
had big call buying back in late September, and the power gauge had actually turned bullish. And then they got a takeover bid, and then someone topped that bid. But this is an example of being prepared and getting lucky. Thomas Jefferson said, the better prepared we are, the luckier we get. And here's an example of that. Power gauge was bullish, unusual options activity that I know Bob spotted, and a huge opportunity to make money on the long side. So that's just one example of the two disciplines converging. I think it's really powerful. So what kind of questions do we have, Bob? I'm happy to
Well,
spend a little time answering them.
well, let me throw a couple at you here. Brooke asked if you could show how Chaikin Analytics previously indicated that the market was going to correct.
All right, so let's take a look at the spider, because this is our primary way of looking at the market. And we're going to look at our relative strength sell signal. What we were seeing, and this is where Bob and I were debating back and forth on a couple of webinars, we saw the S&P having trouble getting through 2100, 2130. It kept bumping up against resistance and then triggering these relative strength sell signals when it dropped back below its 21-day average. And they were all working. And money flow stayed negative. That was the key. When you had these rallies here in June and July, money flow did not turn positive. And that was your first tip-off. The second tip-off was the power bar. There were fewer stocks with bullish than bearish ratings, which meant that the generals were leading the charge, but the foot soldiers weren't following them. This is a tried and true Wall Street technique. The breadth measurements were deteriorating. Now, that doesn't guarantee a decline, but in this case, the combination of negative Chaikin money flow and negative power bar ratings suggested a decline. Then we saw this W bottom, which I really believed was going to hold. And coming out of that W bottom, powerful money flow. So you got a very big rally, caught a lot of bears by surprise. You exceeded the previous peak, which was at about the 1960 level, or the 2060 level rather. And since then, since October, money flow has been deteriorating. Well, that says the institutional enthusiasm is no longer there, and then you've got this really negative pattern. There's a simple way to tell if a market or a stock is strong or weak. A strong stock has a pattern of higher highs and higher lows. So you had that here. Low number one, high number one. Low number two, you exceed that high, that's your pattern of higher highs and higher lows. Then you pull back, that's a higher low. But when you rally up and you fail to exceed that peak, that's starting the downward progression of lower highs and lower lows, and that's where we are today. Now we're going to get oversold, as Bob said, probably based on today's action. If volume was at its peak, which I think it may have been today, then this probably isn't the bottom day. We need to make a low on lower volume. We need the panic in the market to subside. But basically, the combination of Chaikin money flow, our overbought, oversold indicator, and the power bar was our way of knowing that the market was weak. And then this RSP, the Guggenheim Equal Weighted Index, is our secret sauce that we've been using for over a year now. This looks at how all the stocks in the S&P are doing relative to the market, not just the large caps that dominate. And until that turns around, this market's going to have a hard time making any upside progress.
You know, Marc,
I'm sorry, go ahead, Bob.
Well, I was going to say, I was looking at that spider chart again that you just had up there, and I seem to recall last month, even at the last couple of weeks, that there was a lot of the talking heads in the media were saying Santa Claus rally and da 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 da. And I didn't hear you referencing that. I didn't hear you talking about that. I just heard you talking about what the chart looks like, what the technicals are like. Is that's really the message that we want to send here? Is that don't pay attention to anecdotes and whatever the almanac is saying and whatever people are saying in the media. The market should do this. The market should do that. Those are all speculations. What you're looking at in front of you are the facts and not anything but, and real prices that have actually occurred and where patterns are developed, right?
That's exactly right. And there's another ETF that I look at, which is the SDS. This is the leveraged ultra short S&P. And this gives reverse signals. When this gives a relative strength sell signal, that's actually a buy signal for the market on a short-term basis. And that happens when it drops back below its 21-day average, and we're nowhere near doing that. We're 10% away from doing that. So this particular indicator won't indicate a rally unless the market drops another 10% or rallies another 10% rally, and that's not happening anytime soon. So we've got a lot of proprietary stuff in Chaikin that can really help you. One thing I'd like to do, Bob, is to demonstrate the power of the screener, if I might.
Please.
Let's say you were looking for an options trade. Well, first of all, we have a filter where you can restrict any of the output to only optionable stocks, and then you can eliminate stocks that are trading under 20 with low volume and small market caps. And that's really important because it cuts through the clutter. So let's start with the Russell 3000, and let's say we think there is going to be a turnaround coming, and see if we can find stocks that are due to report earnings within the next week. Now, earnings season starts in earnest on Monday after Alcoa reports after the close. So in the Russell 3000 with that filter on, and actually this is just looking at this week's earnings, which there was Constellation Brands where we were talking about it. We'll have the next week's earnings in there as of Sunday. So we're not going to be able to look at earnings. We're going to get rid of that factor, and we're going to look at something else. I'm going to restrict the screen. So here are all the bullish stocks in the Russell 3000. There's 101 of them. Now, I know Warren Buffett likes free cash flow to be strong and doesn't want to pay too much for a dollar of earnings. So let's take a value approach to finding bullish names, and we're down to 15 stocks. Look how fast that was. There's Valero, which we highlighted as a potential buy, a couple of healthcare stocks, an insurance stock. It's a mixed bag of stocks, but the bottom line is they all meet the same criteria. So you can customize this to your satisfaction. Now, let's say instead you wanted to find growth stocks. You go up to our growth universe. So let's say you want large cap growth stocks and you're looking to buy them if the market shows some signs of life. So in the large cap growth universe, there are 41 stocks with bullish power gauge ratings. Google's there. We talked about Google on the webinar. Tyson's Food is in our 20 stock unit investment trust at First Trust. Microsoft has been a fairly strong performer up until the last few days. But let's filter this a little further and say we want money flow to be strong, but we want it to have been persistently strong over 3 months. Remember that accumulation pattern we talked about. And now 41 stocks get filtered down to 27, and we'd like the stock to be stronger than the market. This is our discipline, and now we're looking at only 25 names, and what you can do is save that as a list. Call it Webinar Bulls. View it in the watch list. It brings you back to the workspace, and now that list is in your user lists. And you can do a lot of things with that. You can go into our panel view and see how these stocks did today. looking for volatility, as you saw in Google, as a potential buying opportunity. And you see Constellation Brands, which we had been talking about, that reported earnings. Bob mentioned this to Jim Cramer, had been bullish, outperforming the market heading into earnings, and they reported a positive earnings surprise. So here's a stock you want to buy on weakness. Now, how do you know that the time is right to buy? Well, you've got this list of 31 names, and every day you just look for the signals. So we had a relative strength breakout today in Baxter. Relative strength went above our level that defines bullishness, and this is a stock which you want to be looking at as a potential entry level. So we have this dashboard on the iPad or on the desktop. You click and you see it. And when the buy signals occur, you'll find them. Now here's an interesting stock, CST Brands. Don't know what it does. It's a retailer of motor fuels and merchandise in North America, snack foods, obviously geared to the on-the-go auto market based in Texas. If we want to see the fundamentals, it's all here for you. PE of under 10. Let's see what the earnings look like. Earnings are going to be down in 2012. That's probably why you had, in 15 rather, that's why you had this big downtrend. But now the power gauge is turned bullish, and guess what? Someone knows something. Look at the institutional buying as measured by Chaikin money flow, and now with the stock at 30, 38 rather, you've got relative strength strong. So now you want to just look for a buy signal. And you'll be able to spot that very quickly because you've got a list of webinar bulls that you can refer back to every day to find that buy signal. And let's see if we had an oversold buy in this stock. We didn't. Look for a money flow buy. We got one 2 days ago. This is an interesting stock. Capitalization is not terrible. I think it's got a market cap of $3 billion, so this is a reasonable mid-cap name that you might want to be interested in. This is how easy it is to customize Chaikin to your criteria. If you're looking for growth, value, dividends, one more screener example. Let's say you're looking for dividend stocks. So you're starting with the S&P 500. Let me blank everything out. I could have just hit the reset button. And you want stocks that yield at least 2%. So in the S&P 500, you've got 23 stocks with bullish ratings that yield 2% or more. Now, let's say I want everything, not just bullish stocks, that has a 2% yield. Now you've got a much larger list, 237 names. So let's up the yield to 3%, rescreen. You've got 101 names, bullish stocks, 3% yield. You're down to 34 names. Now there's a lot of electric utilities in there. There's some gas utilities, stocks like AT&T and Verizon. So if you want to put a little bit of the odds on your side, let's say you want to require that the industry group be strong. We talked about that. So strong industry group, screen them out, down to 32 names. Save it as a list, look for a buy signal. You can now customize Chaikin to your personal criteria. It's a big, big step forward in functionality. I know Bob uses this all the time, and a lot of our clients have given us very positive feedback. So Bob, if there's one stock that people want that's a preponderance of interest, I'll do that, and then we'll let people go on their way.
Well, I was going to say Apple, but everybody loves to hate Apple. But let's see here. See a couple of things that a couple of names that people have been looking at. How about Chevron, CVX?
I know you've been talking about these on
Yeah.
Mad Money
Yep.
because of the money flow. And you were right. Whereas the price of crude oil is dropping to new lows, Chevron is holding about 15% above its low. Money flow is very strong. The stock's outperforming the market. The power gauge rating is neutral. Interesting stock. What do we want to look for here? We want to look for a relative strength buy signal, and that's going to come when it moves back up through its 21-day average, but we're in a choppy market here. So this is a stock that I think can be bought on weakness if you believe that some of the weaker names in the energy sector are going to have to sell out because they have a liquidity crisis. Who are the buyers going to be? They're going to be Chevron and ExxonMobil, the stocks with strong balance sheets, who can maintain the dividend. And you've got a pretty good dividend here on Chevron. You've got a 5% dividend, assuming they maintain that. And some of these smaller energy stocks are cutting the dividends, like Kinder Morgan, because they don't have the cash flow to support it. One would assume that Chevron can keep that dividend if they want to, unless things really get terrible. But if you had a choice between buying Kinder Morgan and betting that they were going to survive or Chevron, to me it's a no-brainer. You want to be in Chevron. And that's what investing and trading is all about. It's one versus the other, even within an industry group. Strong stocks, weak stocks. If you know the difference, you're ahead of the game. So I think
Mark,
that's a
Mark,
good point. Yeah, Bob, what do you
Mark,
got?
one question from Helen here. She asked if does the tool scan for Canadian stocks?
Only if they trade ADRs like the banks, like Bank of Montreal um, and Bank of
Sun,
Nova Scotia, which have had bullish ratings, by the way. So
Sun,
BNS.
Suncor is a Canadian oil sands, and um,
What's the
the,
symbol on Suncor?
uh, gosh, I used to think it was
Suncor Energy. There it
yeah,
is, SU.
Suncor. SU. That's right.
Yeah,
Okay.
that's got a bearish rating. I know Canadian Pacific has had a bearish rating, so there are Canadian stocks in here. Now, wouldn't you have loved to have known to be out of Canadian Pacific?
Well, I think famed hedge fund manager Bill Ackman has been long this thing for a while.
Well, Bill
I
Ackman
don't.
was
I
down
guess
20% this year, so good luck to Bill.
is he not a Chaikin Analytic subscriber?
No,
Oh, that's
no.
too bad for him.
The Paulson hedge fund is though, so
There you
uh,
go.
they they know what they're doing most of the time. They caught the Big Short.
That's
By the
right.
way, how many of you have seen the movie The Big Short?
I did. I liked it. I was surprised. Why didn't they? I know Michael Lewis talked about John Paulson, but he didn't mention. They didn't talk about him in the movie. Did you know that?
John's very secretive. He doesn't like to trumpet his successes or shine the spotlight on them. He's just donated an awful lot of money to Columbia University, and he tries to stay out of the limelight. He's actually a really nice guy,
Hmm.
and I think they were looking for the sort of known people to feature. John Paulson's a fixture in New York society and in the charitable world, so. I think Michael Lewis was trying to highlight some of the lesser lights, but
Hmm.
um, a lot of the hedge fund managers, Ackman and Einhorn, are getting killed. And Icon, bottom fishing in stocks where there are fundamental flaws, and you're seeing it. You see it in Chaikin. You get unvarnished truth here. Objective indicators, fundamental and technical, all in one package. By the way, if you were looking for an options play, here's how simple it is. Now, the stock's pretty down, and it's going to suggest bearish plays because it keys off the power gauge.
Hmm.
So if you thought there was more downside in Canadian Pacific, the suggestion here is don't short the stock, but buy this February put spread, the 115-100 put spread. Now, if Chaikin gives you an edge, this is something I wasn't going to get into, but I'm going to do this because I know there are some sophisticated options people from your audience on the webinar. We know that the power gauge rating has predictive value. And this stock is underperforming the market, broke down to new lows. It was down another 4% today, which you don't see on the chart. So you can modify this strategy. Now, how do you do that? Well, you can say that I think this stock is going to drop more than the probabilities suggest. This is a probability-based recommendation. So I actually want to go in and modify the strike prices so that I'm taking a more bearish position, because I think Chaikin is telling me that the stock could go a lot lower. And the way I would do it, I'm not doing it the way I wanted to do it, is with this trading range. The standard deviation, the probabilities suggest that this stock's going to have a range, one standard deviation. If you think it could go lower by February, you can modify this and suddenly the probabilities expand. And that seems a little extreme. So this isn't the best example. But the point is you can modify this to factor in what Chaikin is saying and change the probability assumptions. I did that with the IWM, so I'll just leave with that. Here's the Russell. I felt it could go even more. Let's see what it's saying about the Russell now. Whereas on Sunday it was bullish, it was bearish. It's still finding a nice vertical put spread, the 106.97 put spread. But let's say I wanted to reduce the cost from 269, which would give me a 233% return, and modify that and write the 100 put spread instead. I improve my risk-reward ratio. It cost me only 200 bucks. The probability of break-even is higher. There's a lot in here. It's powerful stuff. And if you're into trading options, this is a tool that is as good as any I've ever seen for both novice